hope for SpiceJet as it struggles to stay afloat a day after the Marans made way for former co-founder Ajay Singh. The Aviation Ministry has told CNBC TV 18 the airline may be exempt from making an open offer. Speaking exclusively to us, Mahesh Sharma, the Minister of State for Aviation, said 1,500 crore rupees could be enough for SpiceJet to stay afloat.
See, civil aviation industry works in the wider interest of the passengers and of course the aviation industry as a whole. We will not like the credibility of this industry goes for future investors and people, players, stakeholders in this ministry and this industry. In the wider interest, if you look that our airlines collapses, before that things has happened with Kingfisher. We don't want it should happen with any other organization. But definitely, we as a government, we as a ministry, civil aviation, cannot be a partner in this affair. If there is a positive proposal comes from that airlines, we are willing to extend help to the best of our abilities and possibilities within the federal structure of our government. That is possible.
So would an infusion of 1,500 crore rupees be sufficient to address the concerns, because Marans have also shown interest in taking over the tax liabilities which remain pending?
See, what we will be interested in the revenue losses or the dues of our government of agencies, the ministries, for which is, if you are telling me this figure, I think it is sufficient to clear our dues. What are their internal dues? Of course, that is not known to us. But the proposal which comes to us, definitely we will screen this proposal on the merits and we'll try to settle out the issue. In case a positive proposal comes and they clear our dues, if this figure of 1,500 crores or even say 500 crores comes and clears the government dues, government will have no problem in carrying on this business.
So the other key issue here is of an open offer which these companies would have to make, but there is also a provision to provide exemption by a competent authority, and in this case that happens to be the Civil Aviation Ministry. Is it possible, or is there a proposal which the government would be considering to waive this requirement of making an open offer?
See, the change is two. One part is clearing of our dues, the passenger services, whatever they are, clearing their any liabilities, and third party taxation liabilities, government liabilities, and third part is a change of head at our level. So that we'll consider on the merit if we see that somebody is infusing, and that it's a routine process which is no favor to anybody. It's a routine process when your organization is changing heads and stakeholders and shareholders are changing. It's a routine process.
Minister of State for Civil Aviation. So hope is in the air for SpiceJet, and sources say the Aviation Ministry is likely to approve the revival plan as early as next week. The ministry, we learn, has not found any financial irregularities in the due diligence. We also learned the company has not taken a decision on phasing out its Bombardier fleet. There were reports that the airline will only have the Boeing 737 fleet going forward. Now, Ajay Singh may have ridden in as a white knight for SpiceJet with a proposal to put together an investment of up to 1,500 crore rupees. But turning the airline around will not be easy. Sindhu and Devina Mandru report that streamlining operations through a mega restructuring drive will be crucial to the airline's survival.
The airline has to make economic sense, and therefore if certain right sizing is required, it will be done.
Ajay Singh knows he has his work cut out for him as he readies to strap himself back into SpiceJet's cockpit. And merely pumping in money into a cash-strapped airline that is staring at liabilities of around 1,200 crore rupees will not turn it around. But Singh says a heavy liability burden is not the biggest problem.
It's not necessary to pay down every single piece of that liability. Some of those liabilities are somewhat longer term in nature. So it's not that, in one fell swoop you'll completely clean the balance sheet. But obviously, the amounts of money that SpiceJet owes to various people, including its vendors, a lot of that will get paid.
But Singh already has luck on his side, at least at the moment. Not just because oil prices at historic lows make for lower operational costs.
The rupee seems to be appreciating, which is great for the airline business. There is a very supportive government which we believe will promote growth over the next several years in the Indian economy. And as you know, with growth comes a great deal of aviation traffic.
That being said, Singh himself is clear that there are many more aspects to the revival plan, including the pressing need to increase a languishing market share, which may mean shutting operations to some unprofitable stations quickly.
SpiceJet was one of the lowest cost carriers when it started operations. Obviously, an extremely important part of what we are about to do is to bring the cost down to a competitive level. We also need to work hard to ensure that revenues increase. We need to also ensure that we revert to a low-cost airline model, which is essentially trying to have a network which is far more contained than it currently seems to be. So you have fewer stations, and you have high frequencies into those stations to keep costs low. It's essentially back to the basics for SpiceJet.
A full review of the twin fleet strategy may also be on the cards, and SpiceJet may move soon to grow its fleet of Boeing 737 aircraft, which has been reduced to less than half of its peak strength last year.
Clearly, there will be an addition to the existing fleet in a fairly short period of time, and that will be part of SpiceJet's plan to ensure that the fleet goes up to an economically viable number.
The staffing angle will not be spared scrutiny either. SpiceJet is learned to be looking at maintaining a manpower aircraft ratio of 120, so depending on how fleet size changes, some layoffs may be around the corner. Also, the cost-cutting drive will involve renegotiating contracts with vendors. But first things first, the revival plan needs to be ratified by the various authorities and regulators, and the subsequent operational overhaul will take at least a year after that. With Sindhu Bhattacharya in New Delhi, in Mumbai, Devina Munro.
Well, that's SpiceJet trying to fly out of trouble. But IT Bellwether, as we pointed out, Wipro beat estimates with a 3.7% revenue growth this quarter. My colleague Kritika Saxena joins us now, and she'll be taking you through those numbers as the Wipro management gets ready to speak to us. Kritika, what a lovely way to spend your birthday.
Absolutely, I'll be here till 10 o'clock at least, I'm assuming. In terms of numbers, Shireen, what a quarter for Wipro.
You seem to have brought Wipro luck.
I do, exactly. Menka too. So both of us have brought TCS. Actually, TCS not so much of luck. Okay, the management is ready.
Well, you've got the Wipro management waiting by, Kritika. So yes. Over to you.
Okay, so my first question, Mr. Suresh Senapati, congratulations. You will now have some time to spend with family and with yourself. Quickly, we have seen you at the helm over the last couple of years. What is the plan now? And, as you leave Wipro, is Wipro right now positioned to be able to capture a larger market share? Last 2 years have been about restructuring, about, realigning your verticals. As you leave the company, is Wipro well poised to grab larger market share from your peers?
Absolutely. I think I feel very positive about it.
Okay.
Q3 has been a good quarter for us, both in terms of volume, in terms of the top end of the guidance, and margin did not decline significantly despite the fact that we such a headwind with respect to cross currencies. And we delivered 3.7% growth, and across the verticals I think everybody has delivered good growth, including GA, IT, infrastructure, BPO and the India Middle East business. So given the fact that what we did in Q2, what we did in Q3, given the fact that on a constant currency basis we are north of 9% on a YOY growth, net income growth has been about 9% compared to last year, and the pedestal that we are in, except for the oil and gas piece, which is currently in a very volatile mode, having oil prices dropped from $100 to sub 45, it gives me a lot of confidence that we are on the right track. We are on the right track vis-a-vis simplicity exercise. We are on the right track vis-a-vis productivity exercise. We are on the right track in investments and technologies. And if we stay this course, we'll definitely do well. And I'm very convinced, as an accountant, I'm used to this going concern concept. So just because I leave, and when I leave, I find this is the dynamic leadership which will take the company much more forward than we have done so far.
Okay, fair enough. TK, quick question to you on the guidance. Excellent set of numbers. I don't mean to nitpick, but guidance is slightly lower than what the street was expecting. Is this owing to the pressure that you're seeing in the energy and utility space? And if yes, for Q4, what is or if you could just quantify the kind of impact that you are expected from that vertical?
So, we don't typically quantify the delta that we get from a particular vertical, but I'll just give you a sense. You know, this particular quarter we have factored a decline in our energy and utility business. And that is based upon what we expect to see with oil prices coming down and the impact that would have on capital expenditure projects overall. So a decline in our energy and utility business from the last quarter has actually been factored into our guidance in this particular quarter.
Okay, we also have Jatin Dalal, the incoming CFO of Wipro, with us. Jatin, you learned the ropes from Mr. Senapati himself. So I'm going to, pose the margin question to you. Breakup margins for me, 21.8%, in line with what we were expecting. Yet, the currency volatility and the hedging strategy seems to be a bit of a nigging worry for margins. Going ahead for Q4, I understand no guidance in terms of your margins, but how is Q4 looking like? Would you be able to beat the headwinds that margins are clearly witnessing?
Yeah, so I think Q3 has been in a very narrow range of our Q2 performance, and to that extent, I would say it's a consistent delivery on operating parameters and operating margins. As I look at Q4, we don't guide on margins, but certainly I would say that if you look at our track record, we have remained consistently in a narrow band in a shorter term, and we have maintained that in medium to long term there are significant headspaces available to us for us to push the margins up. But in short term, it would be a factor of operating parameters for Q4, and we expect it won't move materially from the ranges we have been operating in.
Okay, fair enough. TK, quick question to you before I go to Saurabh. Consulting seems to be very volatile. So if I look at the last 1 year, last quarter it was down, whereas the quarter before that it was actually up by 4.5%. What is the trajectory as far as consulting is concerned? Is that expected to remain volatile?
So last quarter we were affected by consulting primarily around the fact that we had some projects for which we could not bill. Okay. We see growth coming back this quarter, but it's been lumpy growth. Clearly from our perspective, we are aligning consulting today with more and more re-engineering projects as we continue to execute them. Revenue would continue to be lumpy for the next couple of quarters. So at the end of the day, I'm not particularly concerned by the consulting revenue itself. The revenue is not substantial for it to make an impact. Really, for me, the biggest impactor is the follow-through revenue that we're supposed to capture through consulting. Are we capturing that or not? And that, as of now, looks fairly steady.
Okay. Saurabh, attrition is at 16.4%. It has been high for the last 2 quarters. Typically, I do understand that most of your peers, including your immediate peers, do typically prefer to stay within that 11 to 13% comfort range. Q4 would be slightly stronger as far as attrition is concerned. Can we expect Wipro to be able to go back to that range?
So, attrition, if you look at it for the last 2 quarters, it has been sequentially becoming better and better, and we see that trend going into Q4. Very, very clearly, we are comfortable the way it is going. There are some certain pockets in the organization, some certain skill sets where we are focusing on to make sure. But overall engagement levels, overall attrition numbers were in a very narrow band over the last 3 quarters, and we are confident we'll be able to maintain this as we move forward.
Okay, utilization as well, fairly strong for this quarter. Would you be able to see an increase going forward? Because Q4, of course, is strong.
Yes, utilization also for the year, if you see, we have, over the last 3 quarters, we have seen very clearly an improvement. And operationally, we are very focused there on utilization. We feel there's headspace for us to improve it further. So we will be at it, and in the coming quarters, you'll see an uptick there as very clearly from our side perspective.
Okay, fair enough. Suresh, TK in the press conference said that Europe and the kind of deal pipeline that Wipro is witnessing from Europe has never been as good as it is currently. Where really are we seeing the traction coming from? Because, the last 2 to 3 quarters we were talking about Europe actually being sluggish, and now we have seen an uptick in Europe. Where is the traction coming from?
I think a couple of areas. We're seeing traction clearly coming from the big industries, the traditional industries out of Europe, primarily driven for us by auto and heavy engineering. These are the two areas that are actually growing for us. So apart from that, we also see some level of business coming in from services, but most of the incremental growth is being really driven by manufacturing. The way we see it is that with commodity prices going down, we are seeing a large part of the heavy manufacturing base being affected in terms of pricing. The price competition is happening out there, and people are trying to see how they can reduce their base costs. Because as pricing deflation happens for their products, they necessarily have to reduce cost on their overhead side. So that's really where the big opportunity is coming. And for the first time after many years, we're seeing a lot of Indian players participating in it. We're having our fair share of wins, and that's what makes it really bullish for us.
Okay, fair enough. Mr. Senapati, a quick question on the overall deal pipeline. We've been witnessing some amount of commentary on how the deal pipeline would be lumpy, could be either flat to marginally down. Wipro seems to be positive from the commentary that we have heard over the last couple of hours. Going forward, your clients in developed markets and in emerging markets, are they seeing an uptick?
Surely. I think to start with our domestic home front, I think India is doing well. I think the initiatives taken by this particular government with respect to opening up the economy, making ease of doing business far superior, and the kind of projects that they're talking about in terms of a digital India, innovation India, skill India, FDI with respect to opening up all the varieties of segments, is definitely going to give a lot of momentum. We are already seeing that in the financial services. We are already seeing that in the oil and gas and certain other private sectors. And I'm sure as we get into the next fiscal, 15-16, a lot of government projects will come into play. Similarly, we are seeing a lot of positive momentum in Middle East. And US, as you know, market is doing well. North America, we have grown about 11%, and the pipeline looking stronger. So far as Europe is concerned, given the kind of currency pressures that they are, and the kind of growth being so muted, clearly there is cost pressure both in United Kingdom and Europe, European Union. And that is definitely making them more opening up to be able to get into outsourcing. And hence we see a large play, because while they are developed market, somehow our penetration has not been as great. I'm not talking about the United Kingdom, but I'm talking about the continental Europe. And clearly we see, like Kurian talked about, the manufacturing, the auto sector have to be much more competitive in the current scenario, and therefore they are more open to outsourcing than they have ever been in the past. So as we go forward, clearly the US economy is doing well. We will see momentum there. The Indian and Middle East economy is continuing to be doing well. We will see. And because of the pressures so far as the European Union is concerned, we will see a lot of momentum there too.
All right. Completely out of time, gentlemen. It's time to wrap up in that case. And I take this chance, Mr. Suresh Senapati, to thank you for your support over the years on CNBC TV 18. And you will be dearly missed on the channel and, of course, by all of us.